Right now, the market is telling two completely different stories. One side is betting on a Fed pivot, the other is warning about a debt bomb. One of them is wrong. So let's break down the data and look at some actionable setups for the coming weeks.
Let's start with a number, 29. That's the level the VIX recently peaked at, which is a clear signal of serious fear in the market. Now for us, fear often means opportunity. This sets the stage for the battle we're seeing play out.
So on one side, you have the bull case, and it's super simple. The Fed is going to cut rates, and lower rates mean higher asset prices. End of story. But the bear case, well, that's a lot more complicated. It's a mix of a potential AI credit crisis, political chaos, and just general weakness under the surface. This is the core conflict you need to understand right now.
Look, both of these stories can't be right forever. Sooner or later, the market's got a price in reality. Let's dig into the data and see which narrative actually has more weight behind it.
Okay, let's talk about the bull case first. It's incredibly straightforward, which is why so many people are clinging to it. It's what's kept the floor under this market, and it really just boils down to one thing.
If you look at the CME Fed Watch tool, the market is already pricing in a whole series of rate cuts. They're expecting them to start this December and just keep on coming through 2026. And historically, that's pure rocket fuel for the stock market.
And backing this up, you've got the consumer. American Express just posted a record-breaking $18 billion quarter. Spending was up 11% from last year. This tells you the consumer is still strong, and that gives the market a reason to look past the bad news and focus on those future Fed cuts. All right, now for the other side of the coin, the bear case. Because if you look past that simple bull story, there are some pretty significant risks building up. Risks that it seems like the market is choosing to ignore. For now.
The real core of the bear argument is something called the vendor financing circle. Sounds complex, but it's not. Basically, a big tech company orders from an AI startup. That startup then uses the promise of that order to get a loan to buy hardware, and then the hardware company invests that money right back into the AI firm. You see the problem? It's a complete house of cards built on circular money, not actual, real demand.
And why does this matter so much? Because the entire AI build-out has an estimated funding gap of $800 billion. This financing circle is just a temporary patch on a massive hole. If real outside funding doesn't show up soon, this entire sector could be in for a world of hurt.
And you know it's not just the AI bubble. We're seeing red flags pop up all over. The Philly Fed says mortgage fraud is running as high as 3%. The regional banks are still under a ton of stress. And just look at the market's technicals. The rally is weak, it's narrow, and it's being led by defensive sectors. Major ETFs like SPI and SMH, they're struggling to stay above their key trend lines. These are not signs of a healthy market.
So on top of all these financial risks, you've got a layer of political risk that could easily be the trigger, the thing that finally exposes how fragile this market really is.
The next 2 to 3 weeks are what I'd call a specific risk window. You've got the government shutdown dragging on the economy. You've got a hard deadline of November 1st for those US-China tariffs. And all of this is happening right in the middle of Q4 earnings season. That is a ton of potential catalysts packed into a very short period.
And that US-China situation, it is escalating. The US is threatening 100% tariffs. In response, China is threatening to cut off exports of rare earth minerals. That's not just a threat, that's their bazooka, and it's aimed right at the heart of the global tech supply chain.
This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
So how do we trade this? How do we take these two completely opposite stories and build a strategy? Well, we don't guess. We define our scenarios, we identify the trigger levels, and then we plan our positioning based on that.
So for us, the base case right now is cautious. That means holding cash and keeping hedges on. Now, the bull case triggers if the market gets through this risk window and reclaims its key trend lines. The bear case, that triggers if we break the 50-day moving average and see the VIX spike back up towards 29. Those are the levels to watch. So, just to be crystal clear, the bull thesis is this. The market gets through the next few weeks without a major breakdown. Then, positive Q4 seasonality and the promise of Fed cuts take over, pushing everything back into an uptrend and maybe even to new highs by the end of the year. And the bear thesis is just as simple. Some catalyst, whether it's from politics or from the credit markets, hits inside this fragile window. The 50-day moving average breaks, and because the market has no real breadth, we get a fast, sharp sell-off of 5 to 7%, maybe even more.
Okay,
With those scenarios clearly mapped out, let's turn this analysis into 3 specific, risk-defined trade setups to navigate whatever comes next.
First, a straight-up hedge. If you're worried about that 2 to 3 week risk window, long VIX calls are a direct and capital-efficient way to protect your portfolio. The main risks here are obvious. If nothing happens and volatility dies down, time decay and IV crush will eat away at the position.
Second, a setup to actually sell that fear. The ticker is HIMS. There's a pattern here where CEO insider selling causes panic, and right now implied volatility has spiked to a crazy 134%. So the play is to sell cash-secured puts to collect that massive premium, betting that the fear is just an overreaction. Of course, the risk is you get assigned the stock if it keeps falling.
And finally, a leveraged rebound play on Hood. The stock has pulled back almost 19% and is now testing a major support level around $127. For anyone with a longer-term bull thesis, buying long-dated leaps calls is a really capital-efficient way to play a potential recovery. The risk, as always with options, is that if the stock goes sideways or down, time decay will hurt you.
So the two narratives are clear, the risks are clear, and the levels are clear. The only question left is which side are you on? Are you positioned for the pivot, or are you prepared for the pain?
Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.